All right. Good afternoon or good morning, everyone, depending on where in the United States you're logging in from. Thank you so much for joining us here at Clarity Benefit Solutions for today's continuing education course. We are going to give probably 1 minute. We'll kick off at maybe 12:01 Eastern, just to give everyone an opportunity to log in, get settled, get familiar with the dashboard here, and then we will kick it off. So bear with us just for the next minute or so, and then we'll go ahead and get started. Thank you so much for joining.
Thank you. Think we're ready to get started, Ed?
Yeah, let's kick it off. It's 12:01 Eastern. We've got over 300 people in attendance. So yeah, let's kick it over to you, Meredith, to get us started here.
Exciting. Well, thank you everyone for joining us today. This is our webinar, HSA Headaches, Curing Compliance Confusion for 2025. We're so excited to have you here for part one of our 2025 compliance series. Well, we'll walk you through the most pressing HSA compliance issues and how to navigate them successfully. And today's extra special because in addition to offering CE credit, this is our very first SHRM approved webinar. We're thrilled to bring you this valuable content to benefit brokers and HR professionals, and we can't wait to dive in. With the IRS increasing scrutiny on HSA contributions and compliance errors leading to costly penalties, it's never been more important for brokers and HR professionals to have a firm grasp on the latest regulations. Whether you're working directly with clients or managing benefits internally, staying informed is key to avoiding compliance pitfalls and maximizing the value of HSAs.
And that's exactly why we're here today. So the session, as Meredith mentioned, is designed both for brokers, employee benefits consultants, and HR professionals. So whether you are advising clients or managing benefits internally, our goal is to provide you with practical, up-to-date compliance guidance that you can use right away. So Meredith will be leading the way with a lot of the facts and information, and I'll be here to give my comments based on my own interactions and experiences here in the market.
All right, and with that, I'm Meredith LaRoe. I'm Clarity's Compliance Director. I focus on regulatory updates and best practices to ensure our partners stay on top of the ever-changing compliance landscape.
And I'm Eddie Larned, Senior Vice President of Sales here at Clarity Benefit Solutions. And I've been working with brokers and employers for almost 15 years to help them make sense of benefit solutions in particular.
All right, so before we dive in, I just want to go over a few quick housekeeping items to ensure you have the best experience during today's session. It's to minimize background noise and distractions. Second, 1 continuing CE credit for benefit brokers and 1 professional development credit for SHRM certified HR professionals. If you have any questions during this session, whether related to content or technical issues, please use the Q&A feature below the media player. We'll address content-related questions at the end of this webinar. You can access resources, including the presentation slides, in the content widget on your screen's right side. Throughout the session, we'll post polls and audience questions that will pop up as widgets. If you want to gain a CE credit from this session, please participate as much as possible, as responding to these is part of the CE accreditation process. The webinar is being recorded, and once the recording is finalized, we'll send a link to all registrants via email. For those earning CE credit, you should receive your certificate within 3 to 5 business days, provided all participation requirements are met. And finally, for SHRM certified HR professionals, you will receive an email following the webinar detailing how to claim your PDC credit.
All right, so before we dive into today's content, let's take a look at what we hope you'll walk away with by the end of this session. So our goal is to really ensure that both benefits brokers and HR professionals feel confident navigating the complexities of HSA compliance here in 2025. So first, you'll learn how to help clients and employees stay compliant by understanding HSA key eligibility rules, contribution limits, how to manage mid-year changes effectively, Next, we're going to break down how to maximize tax savings opportunities by navigating HSA tax advantages, the reporting requirements, and the compliance regulations. We are also going to discuss some of the most common compliance mistakes. So like things like contribution errors, improper distributions, things that can result in penalties, and more importantly, how you can correct them. And finally, we're going to cover best practices for both brokers and employers to enhance your strategic value, whether it's advising clients or managing HSAs internally. So this is going to include critical compliance areas like non-discrimination testing, plan documents, and employer contribution strategies. So with that, Meredith, you ready to get started?
Absolutely. Let's do it.
All right. So let's start with the basics. Health savings accounts, or HSAs, as most of you know, are tax advantage savings accounts that are designed to help employees pay for qualified medical expenses. So to be eligible, an individual must be enrolled in an HSA qualified high deductible health plan, or HDHP, as many of you are familiar with. The key advantages of HSAs include triple tax benefit. I'm sure you've heard that before, where contributions are made pre-tax, funds can grow tax-free, and withdrawals for qualified medical expenses are also tax-free. And unlike FSAs, HSAs are portable, meaning employees keep their funds even if they change jobs. And of course, unused funds can roll over each year.
All right. So with the rising adoption of HSAs, we feel regulatory oversight is increasing. The IRS is scrutinizing contributions and eligibility more closely, making it a size really to stay compliant. Employees who improperly administer their HSAs risk penalties, and sometimes they're extremely costly. And brokers and HR professionals are critical in ensuring compliance. Failure to follow the rules can lead to tax penalties for employees, which is why it's so important to understand and communicate these guidelines properly.
Yeah, and I think it's important that, typically IRS audits are not specific to an HSA, right? And that's some feedback we get from people from time to time, like, what's the likelihood of my HSA being audited by the IRS? And that's totally a fair point, but I think it's really an important piece to remember is that it's usually part of a larger personal audit or an audit on a business, right? So for example, high net worth individuals, who usually are the folks who are taking the most advantage of their HSA because they can afford to max it out and maybe not touch it and let the funds be invested and grow over time, they're a little bit more likely to be audited with a personal audit, and therefore very important to make sure that your HSA is all buttoned up and compliant in that sense. Because again, we know it's not necessarily the IRS looking specifically at HSAs, as the lead reason for that audit, but it's going to absolutely be part of any personal audit or an audit of a business if that's the case.
It's part of the Yep.
All right. So with that said, we have our first poll question here, and I think we have 5 or 6 poll questions here within today's CE. We would love for you to participate in these. In fact, if you are trying to get the CE, you do need to participate in as many of these as possible. And when answering this, please answer it here within the widget as opposed to typing it into your Q&A box there. That way we can actually see what the poll results are afterwards. So you're not graded on these, but for fun, please do try to participate as best you can. So first question is, what is the key compliance difference between HSAs and FSAs? And you can answer this as A, HSAs require employer funding, FSAs do not. B, HSAs roll over annually, FSAs often have a use it or lose it rule. C, FSAs can be invested, HSAs cannot. Or D, HSAs and FSAs follow the same eligibility rules. So we looks like we already have about 50% of our responses in, and looks like our audience either was paying good attention or just knows their HSA and FSA. So you guys nailed it. The correct answer was B, and over 95% of you, at least that's what it's showing on my screen, got the answer right. So thank you again for your participation. We will have a couple more of these poll questions, and would love to see if you continue to get these right.
They're pros already.
Yes.
All right. So one of the areas that often confuses people is how HSAs differ from FSAs, particularly from a compliance standpoint. HSAs are a bank account and they are owned by the employee and remain with them even if they leave their job. Well, FSAs are employer sponsored and often have a use it or lose it rule, sometimes paired with a limited scope rollover. HSAs allow higher contribution and employees can contribute to that plan. Mid-year changes are also more flexible with HSAs than FSAs, which have stricter rules on adjustments and mid-year changes.
Yeah, a couple of interesting points you made there, Meredith. I mean, first off, there's not really any risk for the employee with an HSA like there is with an FSA. I mean, FSAs, if you are halfway through your year, you've contributed $1,000, you've only spent $100, and you terminate. I mean, you are out that $900 unless you decide to continue your FSA on COBRA. So I think that's a big advantage. And you mentioned the flexibility, which is kind of an oxymoron here since it's called a flexible spending account. But, it really does have what I will say more rigid rules, if you will, for adjusting elections, opting in and out. The health savings account just has a little bit of that added flexibility. You don't have to worry about the use it or lose it at the end of the year or even a cap on your rollover. So great points.
Absolutely. So now let's look at a real world example. An employee switches jobs mid-year. What happens to their HSA? Unlike FSAs, as we've discussed, HSAs are what we call portable accounts even after leaving their job. Of course, the employer contributions stop, and depending on the new plan that this employee or this ex-employee may be enrolled in, they may need to adjust their contributions mid-year, specifically if they're leaving their employer who offered HDHP coverage and then moves to an employer that doesn't. That will ultimately impact their HSA eligibility as well as their contributions for the year.
Yeah, as it relates to the job changes, I kind of think of it similar to a 401k, if you will, where, if you've had a 401k at 3 jobs, you can have 3 401ks, or you can, consolidate them and roll them into one. It's the same thing with an HSA. I at one point had multiple HSAs, one from my prior employer, one from Clarity. I was able to transfer the assets over, consolidate them, get them all in one place. So up to the individual what they'd like to do, but I definitely see some similarities there.
All right. So now that we've talked about that, let's really dig into it. So for 2025, the HSA contribution limits have increased to $4,300 for individuals and $8,550 for family. Limits are generally indexed and increase every year by the IRS. If you're 55 or older, you can contribute an additional $1,000, most commonly called a catch-up contribution. And this limit generally stays constant year over year. Since I've been in the industry, it's never changed, and that's almost 20 years. Don't tell anyone. Keep in mind that employer contributions also count towards HSA contribution limits. In order to maintain HDHP eligibility, the IRS also publishes minimum deductible requirements yearly that the plan must maintain. So for 2025, the single minimum deductible is $1,650 for singles, and for families, the minimum deductible amount is $3,300, with maximum out-of-pockets being capped at $8,050 for singles and $16,100 for families. Again, this is generally indexed on a yearly basis. In later slides, we will discuss strategies for pairing HSAs with HRAs and FSAs using these minimum deductible requirements. There's also deadlines for making contribution. And for the 2025 tax year, that deadline is April 15th of 2026. But the IRS may extend tax deadlines as we've seen recently impacted by natural disasters, which generally also extend deadlines for making HSA contributions for the prior tax year. Again, one of the biggest advantages of HSA is their ability to reduce taxable income, making them a valuable financial tool for employees.
Yeah, I think one of the things people don't realize is that deadline for last year's HSA contributions is actually April 15th of this year. So great opportunity for folks if they haven't maxed out their HSA last year, maybe through their payroll deductions, you can actually do an after-tax contribution towards last year's plan and get a above-the-line deduction on your tax return. So just because the new year has changed, you still have some time where you can make sure you get up to that maximum election for last year.
All right. So ensuring HSA contributions are within IRS limits is critical. The annual contribution deadline is April 15th of the following year, but common errors can occur, such as over-contributions, incorrect employer funding, or missing contributions due to mid-year plan changes. If an error happens, employees must withdraw the excess before tax time, and brokers should be aware of how to correct mistakes using IRS Form 5498 SA or rolling excess amounts into the next year if and when allowed. And again, HSAs don't operate in a vacuum. Mid-year changes like a job switch, changing in your family status, or moving between an HDHP and a non-HDHP all impact eligibility and contribution limits. Employees who enroll mid-year must prorate their contributions based on the number of months they had HSA eligible coverage. Employers and brokers should guide employees through these adjustments to avoid contribution errors.
So I get this question all the time, Meredith, and I always forget how it works. Definitely knew at one point, but I forget. Can you explain like the 13-month rule for being enrolled in a high deductible health plan and how it works with prorating? I know it's something to do with December 1st and through the next year, but can you elaborate if you know what I'm talking about?
Yeah. So the 13th month rule, maybe it's commonly known as the last month rule for HSAs. It allows a participant to contribute the full HSA amount, even if they don't have HSA eligible coverage through the whole year, as long as they have maintained coverage as of December 1st of that year and maintain it through the end of the following tax year. So as an example, let's just say I join an employee coverage on December 1st of 2025. I can contribute the full HSA amount if I have HDHP coverage through the end of 2026. So that 13-month period, as long as I maintain coverage, I'm allowed to contribute the full HSA amount for 2025. Now, if something happens in 2026 where I lose that coverage, then your 2025 contributions would then need to be prorated.
Got it. Thank you for elaborating on that. That's kind of a nice loophole if for employees who find themselves in that situation and want to defer some money tax-free. So that's awesome. All right. Looks like we are. Yeah, go ahead.
If you don't mind, I'm going to log out and log back in. I think there's a glitch. So I'm going to see if me joining back into the session will fix that. So I'll be right back.
Sounds great. Yeah, I'll go ahead and do the poll question. And if that takes Meredith a minute, I will just proceed on the next slide. So sorry about the glitchiness there, the choppiness, folks. So second poll question here. If an employee contributes too much to their HSA, what is the best way to correct the mistake? So you can answer this as A, leave the excess in the account and ignore it. B, withdraw the excess amount before tax deadline. C, tell your accountant and make them fix it. Or D, transfer the extra funds into your 401k. So we'll give everyone 10 or 15 seconds to go ahead and think about this one. It looks like we already have about 33% of our responses in, so that's fantastic. And we will, let's see if we can get over 50% responses, and then we'll go ahead and check out our answers. So there we are. We're at 55%. Meredith is back. And all right, you guys are 2 for 2. You guys were paying attention. So we feel the best answer here is B, withdraw the excess amount before the tax deadline. And to Meredith's point, if you can't, there's a form that can be filled out. So great. Thank you for your participation. And let's keep moving.
Hopefully the glitch is fixed. If not, we'll just have to take it in stride. So now let's look at a real world example. An employee starts the year with HTHP coverage, but switches to self-only coverage mid-year. This impacts their total allowable HSA contribution on a month-by-month basis, depending on when that status change occurred. If they contributed to the full family limit before switching coverage tiers, they may have over-contributed and need to correct the excess before tax time to avoid those penalties.
So this is also one that comes up a good amount, and I assume this is the same answer, but I want to confirm. So if an employee is married and therefore they're enrolled in the HDHP as family, and then one of the spouses turns 65 mid-year, so they join Medicare automatically, that's going to have a similar impact, right? It's kind of the same thing. You need to prorate the amount between the single and the family maxes.
It's a great question. If the spouse's Medicare enrollment changes your coverage on the HDHP from family to single, then yes, that would impact your HSA contribution for the year, and it would need to be prorated based on the number of months you were in family coverage and the number of months that you were in single coverage. Good question.
Got it. Makes sense.
So understanding HSA eligibility is crucial. To qualify, an individual must be covered under an HDHP or a high deductible health plan and have no other conflicting coverage, such as an FSA or Medicare as examples. They also cannot be claimed as a dependent under anyone else's tax return. And if mid-year, their contribution limits may also be affected, as we've reviewed in previous slides.
Yeah, and I've always felt that, the employer shares a bit of a responsibility to educate employees on this rule. I think it's important, especially if you're offering 3 different medical plans and only one of them is HSA eligible. The employee might hear HSA during an open enrollment meeting, and keep in mind, you can open an HSA at the bank down the street. So I think it's very important right from, day one when you're providing that education during open enrollment to say, hey guys, you're only eligible for this HSA if you take this plan. If you're on plans A and B, for example, maybe you can take an FSA, but you can't have the HSA. So just my 2 cents as far as goes to communicating these rules to employees.
Yeah. So one of the biggest misconceptions is that employees can continue contributing to an HSA after they enroll in Medicare. That's once enrolled in Medicare Part A and B, contributions must stop to the HSA, but participants can still use their existing HSA funds. Employees that are nearing 65 need to plan their contributions accordingly to avoid overfunding or funding their account when they should not, considering their enrollment in Medicare.
And that includes like first dollar coverage elsewhere, right? So, and I apologize because maybe you're going to talk about this, but things like veterans benefits, TRICARE, HRA paying first dollar. I know we'll talk a little bit about HRAs and HSAs and how they can or cannot play together, but also even coverage through a spouse's plan, right? So like if I am enrolled in an HDHP, but I also have secondary coverage through a spouse's plan that's not a high deductible health plan, I mean, that's a conflict, right? So you wouldn't be able to have the HSA in that scenario.
Yeah, absolutely. I think a really good rule of thumb here is, does any plans that you have provide first dollar coverage for things other than dental, vision, preventative care, and over the counter? If it does, it likely is going to conflict with your HSA eligibility. Yep.
Thanks.
Yeah, no problem. So a major advantage of HSAs is portability, as we discussed before. Like FSAs, even if they leave their job, employer contributions also remain in the account. And once retired, employees can use their HSA funds tax-free for medical expenses, or after age 65 for any expenses with standard income tax treatment.
So I am not an expert in Medicare at all. I'm sure some folks on the call are, but I'm pretty sure someone can like defer Medicare, like they can push it back a little bit if they're still working. So if someone defers enrollment in Medicare when they turn 65, can they still contribute to the HSA? Does that maintain their eligibility?
They absolutely can. They can, if any employee is working past age 65, which I mean, at this point, I don't think I'll ever retire, and wants to continue contributing to an HSA, they need to delay enrolling in Medicare in order to do so. If they delay Medicare enrollment, it is recommended that the employee stop contributing to the HSA at least 6 months before their planned enrollment in Medicare. The reason I say this is Medicare Part A behind the scenes has a 6-month retroactive start date. And so contributions become ineligible 6 months before filing for that application if you'd waited at least 6 months or delayed Medicare enrollment at least 6 months to continue contributing to your HSA. Also, please keep in mind that if the employee is receiving Social Security benefits, enrolling in Medicaid Part A is mandatory and definitely will impact HSA eligibility.
All right, there you go. I didn't know about that 6-month retro on Medicare Part A. So that's great. Great information. All right, so here is our next poll question. I think this is number 3. So an employee retiring at age 65 wants to maximize their HSA contributions. What is the best strategy? A, contribute the full annual limit and enroll in Medicare immediately. B, delay Medicare enrollment to continue contributing to their HSA. C, enroll in Medicare and roll over the HSA into a 401k. Or D, stop contributing to the HSA at age 65, even if still employed. So again, similar to what we've been doing, we'll give everyone 10 or 15 seconds to go ahead and answer one of these questions here within the widget, and then we'll talk about the results.
I have a lot of faith in this group.
Yes, we're off to a good
You're
start.
doing really well. Very good. Kudos.
All right, looks like we have about 50% of our responses in, so let's go ahead and check out the results. You guys did it again. You're 3 for 3. So not as many got this, but still 63%. We feel the best answer here is B, delay Medicare enrollment to continue to contribute to their HSA.
Okay. All right, so let's look at starts HDHP coverage in July. Can they contribute the full annual HSA limit? Normally, as we discussed, they must prorate their contribution covered within that tax year. However, under the last month or the 13-month rule, they may contribute the full limit if they maintain HDHP coverage through December of the following tax year. Lose HDHP eligibility mid-year, excess contributions must be corrected to avoid those tax penalties.
Yeah, this is another one that definitely comes up a lot, and I have a feeling a lot of employers and employees do not adhere to this particular part of the regulation and therefore could be subject to penalties. So I would suggest when these scenarios come up, if you're not 100% sure how to handle it or what the regulation is, definitely consult your HSA partner and their compliance department, so you make sure you get the right answer and keep everyone's plan in compliance to avoid these penalties.
All right. So now that we've covered HSA eligibility and portability, let's turn our attention to an important compliance issue, which comes up a lot: how HSAs interact with other tax advantage accounts like FSAs and HRAs. Understanding these rules is critical to ensuring compliance and avoiding costly mistakes, not to mention massive employee confusion. One of the most common compliance pitfalls is pairing HSAs with FSAs and HRAs. The general rule is that a standard FSA or HRA that provides first dollar coverage for medical care typically disqualifies an employee from contributing to an HSA. And ways that you can build out your benefits, like enacting a limited purpose FSA that covers dental, vision, over-the-counter expenses, and offering post-deductible HRAs that provide funds after the minimum HSA deductible is met. Employers and brokers must structure benefits carefully to maintain HSA eligibility and overall.
Yeah, I'm a big fan of the HSA, HRA stacking concept. Definitely not a fit for every single employer out there, but it's great for, I think, some companies who want to offer basically the richest possible HSA qualified plan, right? So basically layering on that HRA to cover the back portion of the deductible, so that once the employee satisfies that HSA minimum deductible, they don't have any more out-of-pocket costs. It really lets them save more money in their account, accrue a nice balance, begin to invest that money. So again, it has to fit into the budget and the overall strategy that an employer is looking for. But again, if you want the richest possible HSA plan design, this is one of the ways to do it. And I think it's great for attracting and retaining talented employees who maybe they have an HSA already. They want to continue to have an HSA, invest the funds. I think they can really maximize it. So it's not super common, but I do like the strategy.
Agreed. So let's talk about this. It's always the most interesting when an employee or a group is transitioning from an FSA to an HSA. Timing is everything, right? An employee cannot contribute to an HSA if they have a general purpose FSA. Strategies to maintain compliance include spending down FSA funds before the end of the year in the event that they have a grace period, converting grace period or rollover dollars to limited or post-deductible funds, or removing the grace period entirely for all plan participants. Employers should communicate transition rules clearly to avoid unintended non-compliance or confusion among plan participants.
All right, next poll question. An employee has an FSA with a grace period and enrolls in an HSA on January 1st. Which of the following statements is true? A, they can contribute to the HSA immediately. B, they must wait until the grace period ends before contributing to the HSA. C, they can use their FSA for medical expenses, but cannot contribute to an HSA. Or D, their employer can automatically transfer the FSA balance to an HSA. So we will give everyone a couple seconds here to go ahead and review this and respond. And then we can go ahead and check out the results.
I'll be interested to see the responses on this one.
Yeah, this one's a little trickier than the first three. All right, looks like we have almost half our responses in. So let's go ahead and check out these results here. And boom, you guys got it again. It is B again. They do have to wait until the grace period ends. It's actually the month after the grace period ends before contributing to the HSA. And Meredith, you can keep me honest here, but I think it is the next month because HSA eligibility is month by month, right? So it's not like if your grace period ends March 15th, you can start to contribute on April 1st. Does that sound right?
That's correct. Yes, HSA eligibility is determined on a month-by-month basis. So if your grace period ends in the middle of, say, March, you'll have to wait until April 1st to become HSA eligible and start contributing.
Got it. So that was a tricky one, and still more than half of you got it right. So thanks again for your participation so far.
All right. So FSA grace periods and carryover rules can and will ultimately impact HSA eligibility. A grace period, as most of you will probably know, allows employees to use FSA funds into the next year for a period of time, generally 2.5 months, while carryovers let employees roll a portion of their remaining available balance into the next year. However, employees with FSA balances in a new year are disqualified from HSA contributions if a grace period or a rollover are triggered. Employees with a grace period with funds available must wait till the first of the month following the grace period end date to start contributing to the HSA. And again, that's because HSA eligibility is determined on a month-by-month basis. Employees with a rollover and fund availability are in contributions for the entire next plan year, regardless of when the rollover balance is used. It's not about balance, it's about coverage. So if a general purpose rollover is triggered, that coverage is for that entire next plan year and does trigger ineligibility to the HSA. Possible ways to prevent compliance issues for FSA plans with rollover include require a minimum FSA balance to trigger. Someone with $5 or less than $5 may not want that to roll over, and you can make a rule that says I don't want any employee balances less than $5 rolling over. An employer has the ability to designate rollover general purpose rollover funds to limited purpose, as well as the ability to waive rollover to preserve HSA eligibility. For a rollover, for a grace period, possible ways to prevent compliance issues include the employer is able to amend the current plan to remove the grace period prior to the end of the plan year, or amend the plan to convert all grace period dollars to limited or post-deductible funds. In either case, in any scenario, the plan itself, the employer plan itself, does need to be amended before the plan year ends, and it cannot be a choice among plan participants, meaning they can't pick and choose what they want. The plan will operate in a certain way, and the employee's plan must function according to the plan guidelines.
All right. Lots of good information there, Meredith. Thank you. And also seeing a ton of great questions in the chat here. I promise we will leave a couple minutes at the end where we will go through a couple of these and answer as many as we can. And if we miss any, we will have your local rep at Clarity follow up with you to answer those. So rest assured, we see your awesome questions. We'll make sure they get addressed.
Yes, absolutely. So we love real world examples, right? So here's another one. An employee has an FSA with carryover funds from the previous year and enrolls in an HSA for the new year. What's the compliance issue, Eddie?
Yeah, so it's the presence of the FSA carryover, right? That means they're ineligible to contribute to an HSA for the entire next plan year. I think that is something that folks definitely miss out on or don't realize. Employers can prevent this issue by converting, like Meredith said, that carryover to a limited purpose FSA, allowing for vision, dental, over-the-counter items, and preventative expenses, but it also does not interfere with the HSA eligibility. And I think also that doesn't prevent anyone from electing in a general purpose FSA that following year. It's just changing this carryover. So that's a common strategy when a company is introducing an HSA for the first time, but has a bunch of employees on an FSA from last year. So good point there.
Yeah, I think a common misconception is, well, rolled over, but then they spent all their rollover money. It's not about the balance, it's about the coverage. So they were covered and a rollover was triggered. So that does really ultimately impact HSA contribution eligibility for that entire 12-month period. So it's important to understand that and to stop it at its pass. So great stuff. So now that we've covered HSAs and HRAs, let's kind of shift to another critical topic, common HSA compliance errors and the penalties that can result. Understanding these mistakes can help brokers and HR professionals avoid costly issues for both employers and employees. HSA compliance mistakes typically contribution errors, what goes into the account, and distribution errors, what comes out of the account. Employers and employees may overfund an HSA, miscalculate prorated contributions, or fail to adjust for mid-year eligibility changes. On the distribution side, common errors include using HSA funds for non-qualified expenses, failing to maintain proper documentation, or incorrectly reporting distributions on tax forms. All of these mistakes can result in penalties, so it's important to be proactive in avoiding them.
Yeah, I totally agree, Meredith. And like I mentioned earlier, I think we all have a responsibility, both, us as HSA administrators, you all as brokers and consultants, HR managers. We all do have a shared responsibility to the employee population to provide the education and on the rules and the compliance around HSAs, right? So while the accounts are owned by the employees, they are sponsored and usually offered by the employer. So ultimately, in case of an audit, it is usually the employee who's going to be assessed the penalties, and the employer, should help provide the education to help their employees. Because like I said, employees can open an HSA at the bank down the street, and you might not even know about it. And I agree, if they're going to not follow the rules and not be compliant, yeah, that's kind of on them. But let's at least give a good faith effort to give them some of these facts.
Absolutely. So the best way to manage HSA compliance is really to prevent errors from happening in the first place, right? Employers should educate employees about contribution limits and how mid-year changes affect their accounts. Employers should also monitor their contributions, and employees should also do this to prevent overfunding. If an error does occur, which it can, employees need to correct it before the tax deadline. Excess contributions should be withdrawn, and misused funds should be reported and repaid. Employees can also amend their tax filings to fix reporting mistakes.
Yeah, great points there, Meredith. And I'll also point out when it comes to education, I don't think it's overly realistic to include all this information and all these nuances in an open enrollment meeting when you're covering, 3 medical plans, a new dental plan, all your other great benefits that are being offered, But one strategy that we've seen that's effective is maybe 1, 2, or 3 months into the plan year after open enrollment, then going into a little bit more depth, at least just for those folks who are enrolled in the HSA, and giving them some of this information, whether it's information on the compliance aspect, but also, some of the great investment capabilities that folks can take advantage of as they start to accrue a nice, healthy balance in their HSA through their payroll contributions. So lots of different strategies that can be impactful.
Absolutely, Eddie. I'm a huge proponent for continuing education, right? An employee is not going to understand a million things coming at them during open enrollment. I certainly wouldn't. So continuing to pace the education and bringing it up at critical times in the HSA life cycle is certainly going to help.
Yep, absolutely. All right, so another poll question here. We're moving right along. What is the most common HSA compliance error? A, using HSA funds for non-qualified expenses. B, failing to submit HSA receipts to the IRS. C, not contributing enough to maximize benefits. Or D, rolling over the HSA funds into a 401k. So we'll give everyone just a couple of minutes or a couple of seconds, I should say. Mine is showing that we're at about 25% of you all have responded. So we'll just give another few seconds. And I could see an argument for any of these answers. So we're just going to go with what we feel as is the best. And wow, so we had a different feeling than you guys, but clearly the overwhelming majority here is using HSA funds for non-qualified expenses at 88%. We also felt that a good argument could be made for failing to submit receipts to HSA receipts to the IRS. But I think that deserves some clarification because the IRS only requires those receipts to be submitted if there is a personal audit. So what we recommend is having a folder or a file where you keep all of your supporting documentation related to any spending out of your HSA in case that audit occurs. But quite different from an FSA or an HRA, where an administrator might ask you for supporting documentation on a regular basis. HSAs, that's not the case. It is the employee's account. They can spend their funds however they wish, but we do recommend that they hang on to their receipts. But we certainly see those scenarios where HSA funds are used for non-qualified expenses. So that's great feedback.
Okay. HSA compliance errors happen, and they definitely come with financial consequences. As you can see from this slide, they're not tiny. They are quite costly. So over contributing to an HSA results in a 6% excise tax per year until the excess is withdrawn. Non-qualified withdrawals trigger a 20% penalty as well, plus income tax if the account holder is under 65. And failure to report HSA transactions properly can lead to IRS audits and additional tax liabilities. This is why proper record keeping and compliance education are essential. Sorry. Let's look at another real-world scenario. A company mistakenly overfunds an employee's HSA. How should they correct this before penalties apply? The first step is to identify the error as soon as possible. Solutions to help catch issues early. The excess amount, again, must be withdrawn before tax deadline, and the employee must work with the HSA provider to ensure the correction is processed accurately. Finally, employers should ensure all corrections are properly documented on IRS Form 5498 to maintain compliance.
Yeah, and I think that on one hand, the nice thing is that most payroll platforms do enforce the IRS maximum contributions, so they actually won't allow an employee to over contribute to their HSA. But kind of what we talked about earlier, it's important to remember that employees can also make after-tax contributions to their HSA, which lives outside of the payroll system, and HR might not have visibility to that. So it is just something to be aware of. I could have maxed out my HSA contribution through payroll and still transferred another $2,000 from my personal account into my HSA. now I've over contributed, and that is not allowable. So as Meredith mentioned, it is also common for the HSA administrator to provide that form 5498 SA. But again, the account holder should definitely review that at tax time for accuracy so they can correct any overages.
Absolutely. Agreed. So now that we've covered common compliance mistakes and penalties, let's kind of shift our focus to the tax implication and investment options available for HSAs. Understanding these aspects is key for both employees and employers to ensure proper tax reporting and compliance. So, as we've mentioned, HSAs offer a powerful triple tax savings. It's the only one in the tax code that does. This is why I love HSAs. Contributions are tax-free, funds grow tax-free, and qualified withdrawals are tax-free as well. However, to maintain compliance, employees must properly report contributions and withdrawals. The IRS requires two key forms: Form 1099 SA, which reports HSA distributions for the year, and Form 5498 SA, which details contributions and balances. Employers and employees must ensure these forms are accurate to avoid compliance issues.
Yeah, I'll say it again, and everyone's probably heard it a million times by anyone who sells HSAs. But again, the only item on the IRS books that is triple tax advantage. So you probably hear us say that all the time, but it's a big deal. It makes this such an attractive investment, long-term investment, and tax savings vehicle.
Yeah, absolutely. HSAs can be invested, which I think is awesome. Allowing employees to grow their healthcare savings over time. Investment options include interest-bearing accounts, mutual funds, and even stocks and bonds. However, compliance remains a key factor. HSA funds must still be used for qualified medical expenses to retain those tax advantages. If non-medical purposes before the age of 65, they will face taxes and penalties.
Yeah, and I think this is an important note considering the modern investment capabilities that some HSA administrators offer. More and more HSA account holders are now taking advantage of these investment capabilities. I mean, I personally have seen the investment capabilities change so significantly over the last 15 years. I mean, now some of the tools that we have access to remind me of, your Charles Schwab account or your app or your E-Trade or your Robinhood app, like the ability to trade stocks and ETFs and do fractional shares, to be able to essentially day trade with your HSA. Not that that is an effective strategy, but still the capability exists. Set up auto transfer. So it's definitely something that's getting really popular. In fact, out of all HSA account holders, only about 8% are investors. But we see that number go up year after year. And of that 8%, their average investment balance is over $23,000. So those are folks who really understand the value here. I mean, I've actually talked to people who we work with who have $80,000 and $90,000 in their HSA. They just invest as much as they possibly can. They do a set it and forget it approach. They try not to use the funds if they can afford it, even if they have medical expenses. And you build up a nice nest egg for either something big that's unexpected or even after age 65, just the care that you'll need. So a lot of effective strategies when it comes to the investment capabilities.
It really, really is an account that works for you. It's an account that your money makes money. And I think that's a wonderful trait of an HSA just in general.
Yep, completely agree. All right, so it looks like we have our final poll question here. So thank you guys for bearing with us. We only have a couple more minutes. So what is a key compliance consideration when investing HSA funds? A, employee can withdraw HSA investments for any purpose without penalties. B, HSAs must follow IRS rules to maintain tax-free growth. C, HSA investments must be fully liquid at all times. And D, employers must manage HSA investment accounts for employees. So we'll give everyone a second to think about that, and then we can go ahead and look at our answers. You guys are pretty quick on your responses here, so why don't we just jump right into it? And you guys nailed it again. So correct answer is B, HSAs must follow IRS rules to maintain tax-free growth. I've had groups ask about, does the employer have a fiduciary responsibility, which kind of relates to option D down here at the bottom, to manage HSA investment accounts for employees like they might for a 401k or something else. The answer is no. It's the employee's account. It's the employee's money. They can invest it or not invest it however they see fit. So again, investing is not for everyone. Not everyone has that risk tolerance. Not everyone sees their HSA as an investment vehicle. So it's up to the individual. So you guys crushed that one. That was correct.
Good job. So let's excuse me. Let's examine how HSAs work in retirement. When an employee retires, they can continue using HSAs for qualified medical expenses tax-free, as we've discussed prior. However, if they this after age 65, they will income tax but won't face any additional penalties. So essentially, they'll just pay income tax on their distribution. It's crucial that retirees properly report distributions on Form 1099-SA. Again, that records distributions from the HSA, and keep records of their expenses in case of IRS audits.
And I have a funny
story here.
I do. Yeah, I heard this like a month ago, and it actually fits perfectly into this topic, especially what your last comment there, Meredith. Keep records of your expenses in case of IRS audits. I had a friend of mine who was asking about what I do for work, and we were talking about HSAs. I know, super exciting, right? And they're like, "Oh, my uncle just bought a boat with his HSA," and I was like, "What are you talking about?" So the uncle knew the IRS regs and basically had turned 65 and cashed out $40,000 out of his HSA and bought a boat with it. And he has an entire folder of every HSA eligible expense from the past 20 years that adds up to over $40,000. So he's basically able to write a check out of his HSA into his personal bank account, and has all the supporting documentation to back it up in case of an IRS audit, and bought a boat with it. So obviously that's a bit of an extreme example, but goes to show you, if you really understand the regulations, you can maximize this benefit to so much beyond just medical, dental, and vision.
That is one smart saver, I'll tell you. So as we wrap up today's session, let's discuss the importance of working with a compliant HSA provider and take a look at upcoming trends in HSA compliance. And ensuring proper administration of HSAs is critical, again, as we've stated, for both employers and employees. Choosing the right HSA provider is essential for maintaining compliance and ensuring a smooth experience for employees and employers. A reliable provider will help us rules, provide necessary tax forms, and offer education on HSA as well as best practice. Employers should seek out providers with strong compliance expertise, user-friendly technology, and seamless integration with payroll and benefits platforms.
Yeah, and I'll just add to that last thing you mentioned, seamless integration with payroll and benefits platforms. I mean, in today's day and age, it feels like 90% of businesses are at least on a Ben admin platform. So there's tons of opportunity to automate, right? And let the technology do the work for us, and keep human hands away from touching data and sending information around contributions and eligibility. So important to ask about integration capabilities, but not just with the Ben admin system, because Ben admin sends over eligibility and demographic and elections, but it doesn't send over payroll contributions. And you don't want to make assumptions with payroll contributions with an HSA like you can with an FSA, because an HSA is an actual bank account. Remember, you have to adhere to federal banking laws. So an incorrect HSA payroll contribution can be a pain in the neck to have to reverse. It can be a little bit challenging. It takes some time. It's not as easy as some of these other benefits like pre-tax commuter or dependent care, where it's like, oh, that person changed their election, let's just go in and fix it. HSAs can be a little tricky. So definitely ask about that when you're identifying a partner. Integration is a key here. We want to leverage the technology to create automation for your clients so that there's fewer errors and they just have less work.
Absolutely. 100% agree. So looking ahead, we expect to see increased IRS scrutiny on HSA compliance, particularly in tax reporting and contribution limits. More employers are expanding HSA investment options and increasing their contributions to stay competitive in today's job market. Additionally, a larger role in preventing compliance errors and making it even more important for HR teams and brokers to stay informed.
All right. So today we covered the compliance essentials of HSAs, but really, what about the bigger picture, right? So how can you drive adoption, increase engagement, optimize cost savings? That's really what we're going to cover in our next webinar, which is beyond HSA compliance. It covers trends, strategy, and what's next for you all as benefits professionals. So for that, we're going to actually be joined by our partners at hsastore.com. Some of you may have heard of hsastore.com or fsastore.com, same company. And that's going to be part 2 of this webinar series. So you definitely don't want to miss it. If today brought you value, that one's going to go a little bit more into strategy. And the great news is that session is also going to be SHRM accredited. So for your clients, please make sure to sign up and continue to expand on your expertise.
And hopefully there will be no glitches in the matrix for that one. Sorry, guys. Truly apologize. But before we wrap up, I want to thank you all for attending today's webinar and dealing with me through my glitches. We certainly appreciate your time, engagement, and patience. But before we kind of move into the Q&A, here are a few final housekeeping reminders. First, we will be emailing all attendees a link to the recording, along with any resources and details about the rest of our compliance series. So please keep an eye in your inbox for that follow-up. For those earning CE credit, your certificate will be issued within 3 to 5 days have been met. You guys did a great job at answering all the poll questions, so I'm sure that they will be. And for SHRM certified HR professionals, you'll receive an email after the name, your SHRM PDC credit. And with that, we have about 5 minutes to answer some questions. I'm happy to answer those. And to Eddie's point, if we can't get to your questions, there's a lot of good ones in the Q&A. I don't think we'll have time to answer all of them. Your regional sales rep will follow up with you after this session. So Eddie, have you got any questions for me?
Yeah, we got 4 minutes. Let's see how many we can cover. I don't know if we've ever had this many great questions. So thank you all for your engagement. Melanie asked, how do you withdraw excess funds from the HSA if you overfund it?
You'll want to work with your HSA provider, whether the bank or the TPA. They usually have a form that you complete. You send it into the bank, and you'll work with them to correct it.
Great. Stephanie asked, if the employee doesn't have a balance in their FSA for the next year, are they still ineligible for the HSA for that following year?
Great question. Great question. And I meant to mention this. For grace periods, if you spend your money at the end of that year, say your plan year ends 12/31 of 2024 and you've spent all your money, you're good. You're golden. It's only if it's triggered with a balance into the next year. Great question.
Great. This one is related, but I'll still ask it anyways, just so we can answer. Jose asked, if there is a rollover provision, but no funds are rolled over, then the employee can contribute to the HSA, right?
If you've spent all your money by the end of the year. Yes.
Okay, great. Let's see what else we have. Let's see. Teresa asked, so to be clear, if you are drawing Social Security and Medicare, you should not be participating in an HSA. And I think the key there is participating. Meredith, can you elaborate on that?
Yes. So there is spend down in an HSA, and then there's participating. When we say participating, we mean actively contributing to an HSA. And no, getting Social Security and actively enrolled in Medicare, they should not be participating, contributing to that HSA. They can spend down what they have, right? It's their bank, it's their money, but they can't contribute. That is right.
Yep. Thank you. I think that's an important distinction. I can answer these next two pretty quickly. Tasha asked, where can you find out if your plan is set up with a grace period or a rollover? That's referring to an FSA. That would be your FSA plan document, or asking your FSA administrator. But every FSA plan is required to have an FSA plan document that outlines all the rules and parameters around your plan. That's where you would find that for certain. Erin asked, does Clarity have the ability to switch for the employer, move from a full purpose healthcare flexible spending to a limited purpose FSA? That answer is yes. Tracy asked, FSA grace period can be switched to limited purpose FSA at the end of the plan year to still contribute to the HSA once first eligible. So I know we talked about that for grace period. I'm sorry, for rollover being a yes. What about for grace period?
Yes.
Yep, great.
You just have to make sure that you amend that plan before the end of the plan year in order to maintain compliance.
Yep.
With the rest of the requirements.
All right. Andrea asked, can an employee have a limited purpose FSA and a rollover and an HSA? Yes, if it's a limited purpose FSA. So that's how you maintain your HSA eligibility to contribute to an HSA, is by having a limited purpose FSA or limited purpose FSA rollover.
That's correct.
All right. So looks like we are right about at 1 o'clock Eastern. So I think we will wrap it up here. Again, any questions that we weren't able to get to, and we had over 100 questions and comments. So thank you so much for your participation. We will absolutely be following up on all of these. But I just want to thank everyone for your time. Thank you for bearing with us through our tech issues or challenges. And thank you, Meredith. As always, we appreciate your expertise. And please don't hesitate to reach out if you have any further questions.
Thanks for your time today, guys. Have a great day.